Let's get him in here. Greg Anderson joining us from Citi FX. Walk right in here, Greg, and sit down here. I know you for years doing LATAM, but it's now more of a G20 thing. What a quiet G20 meeting. You're absolutely dead on in your note. Who cares? Why is nobody looking at this 18-19 meeting?
Well, I think there's several things. First off, the winter meeting tends to get less attention because there's not an IMF ahead of it.
Right.
But in this case, we had a big blow up in October between the U.S. and China. And I believe France, as the host, has tried to keep that on the down low this time. The tensions are still there. And I think the arguments have an additional element, which is who's at fault for rising food prices.
Yeah,
but,
so there could be a backstory here that gets our attention.
Yes, it's there, and I think it will be every bit as contentious behind closed doors, but, you know, like I said, France will do their best to try to keep it out of the media.
Right. Let me do this. I want to bring this up on Jim O'Neill. Early this morning on Bloomberg Surveillance, I spoke with Jim O'Neill of Goldman Sachs about Wayne Rooney's great goal. Well, no, wait, actually, I did that. We talked about Wayne Rooney's goal, but seriously, I talked to him about the future of growth economies.
Within the so-called emerging world, there are 8 economies currently, and in the future probably more, who are sufficiently large already and who are likely to grow at a rate stronger than the world growth trend, so will become more and more important to the world.
Jim O'Neill at Goldman Sachs. Greg Anderson, the idea of growth economies versus emerging markets and relative growth rates. Is the tension within the G20 just a response to almost a chronic excess of growth in these other nations year after year? 8%, 9%, 8%, 10%, where we're talking 2 or 3 or 4%. At some point, that's got to catch up with the developed economies.
Yeah, so these major developed economies have taken a position where they are at the forefront in trade, both in growth of trade and as well as quantity of trade.
Right.
But their economic management policies, in some cases, have not evolved as quickly as the rest of the economy. And so this is the source of the tension. The old G7 have fought with each other over things like exchange rates for 30 years, and now we just have 3 years with the G20, and we're still learning.
Let's look at this chart here. We're still learning. You can see the chart down here, Greg. We have a weak dollar policy. That's my own language, folks. That's not Tim Geithner. I don't want to get in the timeout chair at the Treasury Department, but there's trade rated real. I'm sorry, we've reversed the Rubin strong dollar. With or now, do we go to new dollar weakness?
I think we do. The market is really short of dollars right now, and so, you know, I wouldn't expect new lows to happen on Monday after the G20, but I would expect it as we go through the year. Look, the Fed is not going to raise until the very last of the central banks, and most of G5 through 20 are raising now, and the ECB will be ahead of the Fed and the Bank of England pretty soon.
Critical distinction here in your call. Very much, we're hearing a lot of people say stronger dollar. It's not just about the interest rate in the U.S., it's about relative rates. And are you suggesting that, yes, the U.S. may raise their rates, but others will raise them as well, or even more than we will?
Yeah, they'll raise first, they'll raise more, they'll raise faster.
That sounds like a research report title. You could do that absolutely. Let's bring up too much information here while we can here. And I love this chart. This is Asia DXY. This is back when I knew Greg in Boston. There's the financial crisis over on the left side, off a cliff, weaker Asian currencies ex-Japan, and then a struggle, and then the persistence. Say, okay, a crisis got in the way. I mean, this is 9, 10, 11 years of Asia ascendant, isn't it?
It is, and I guess if you went and looked back at the economic growth differential, though, it's more like a 40-year ascent. And the currency is the last thing that has moved, and that was a policy decision.
How can people play this?
I think the way you have to play it is to continue to be short dollars against high yielders. So we are big fans of Swedish kroner, Australian dollar, Norwegian krone in the G10. And then in the G20, you have to pick your spots, but remain long the highest yielding and most attractive currencies, and I would put Mex peso in there, I'd put Brazil in there, I'd put Sing dollar in there.
I mean, this is really cool, and that what you're saying, you and Steve Englander are saying, is stay the theme of the last 5 or 6 years, where a lot of other houses are saying, no, do this different, do this different. It's a different time. What I'm hearing you say is dollar weakness and keep with those high yielders.
We're not going to flip, I don't think, until the Fed starts to raise rates, and we're still somewhere 15 to 24 months out on that.
Let's bring up this op-ed, Vox. I thought this was really a smart note. Go to Vox EU, folks, for some really interesting stuff, particularly from academics that you don't know that well. Avanish Prasad here, Intelligence Capital. The fog of the currency war, the exchange rate manipulator is the United States. It is far easier to manipulate a floating currency lower than to manipulate a fixed exchange rate, alluding there to China to a great extent. Do you agree?
I don't.
We like that. You don't agree. Breaks loose. Put out a banner. Greg Anderson does not agree.
It is very difficult to manage a true floating exchange rate. And interest rate policy sometimes works. Verbal intervention occasionally works. But it is tough to do. And that's why China hasn't moved to a complete floating currency yet. They're still not comfortable with taking that last step.
Greg Anderson, thank you so much. With Citi FX.